They're both right. What Jeff Christian will suggest is that there is no deficit because there's inventory. And strictly speaking, that's true. There is a deficit if you look at the amount of silver that's consumed every year relative to the amount of silver that is produced from silver mines or is a byproduct of other metals or is recycled. And frequently the silver bulls suggest that this deficit is so overwhelming that the silver price has to move. What those bulls neglect to point out is that there's several billion ounces of above ground silver in inventory that doesn't have to be mined. Silver, unlike gold, is used. It's important to note that it's used in for reflective capabilities, as an example, in solar industry. It's used in microelectronics, in regular electronics. It's also increasingly used as a germicide and in water treatment facilities. And a bunch of silver every year, goes out a tailpipe or goes up a smokestack or something like that. It goes to silver heaven. More silver every year right now is getting used and is getting produced. But there are enormous stockpiles of above ground silver, and nobody really knows how much. I remember back to the 80s when Buffett suddenly announced that he owned 15% of the reported above ground stocks of silver. The silver price promptly doubled. All the short squeeze guys, even in the 80s, came out from under their bridges or wherever they were. And all of a sudden, the silver price collapsed. And all the silver bulls were saying, well, this must be manipulation. This must be J.P. Morgan Chase trying to screw me. What it was that there was a whole bunch of physical silver owned by the Indian peasantry. The silver price doubled in U.S. dollar terms, and the U.S. dollar doubled against the Indian rupiah. At the same time, I forget if there was a flood or a drought, one or the other, but there was a bad harvest in India, and the Indian peasantries had to make a choice between selling an asset class that was up by 400% or allowing their kids to starve. Pretty easy decision. So in the context of the question that you asked, both parts are right. There is a structural deficit in terms of new mine supply or newly created supply relative to industrial demand, but there are enormous above ground inventories. The experience of Sprott, going back to 2014, 2015, the silver squeeze, is instructive. The narrative around silver was in full swing, and the easiest way for American investors to express their sentiment was the Sprott Physical Silver Trust. We as Sprott were able to use an at-the-market financing mechanism to convert this market activity into cash, which we used to buy silver. And for a while, we were raising $40 or $50 million a day. And our charter prohibited us from taking depository receipts. We had to take silver. So we couldn't hang around and try and buy that silver at the best price from the best taker. We cleaned out the silver that was available to us in Toronto. We cleaned out the silver that was available to us in Ottawa. We then cleaned out Chicago. We then cleaned out New York. Sidebar, gold is expensive and easy to transport. Silver is not expensive and it's tough to transport. And the people who owed us the silver, the J.P. Morgan Chases of the world, had to charter these very large airplanes to fly physical silver to us from Switzerland and London. Now, it wasn't that the silver was unavailable on a global basis. It's that the silver was unavailable where it was needed. And that goes to the futures markets. It's very common, Donegan, we've talked about this on your show before, because the futures markets are so liquid, because they trade such amazing volumes, it is not uncommon to see a single 24-hour period trade 200 times the physical silver that's available for good delivery. Now, invariably, these things cash settle. But if you thought about a very small amount of the futures transactions that was held for good delivery, that would absolutely overwhelm the futures market. Participants in the futures markets, or those who look at the futures markets to engineer a short squeeze, need to understand that the futures markets are owned by the futures markets participants. And if we had this type of short squeeze, it wouldn't physically settle. What would happen is that the exchanges would do what they did with tin. They would halt transactions, they would arbitrarily establish a price, and they would cash settle. That's what'll happen. If you actually think that you're going to catch the owners of the exchange way short, I got a bridge to sell you. But a circumstance that caused that to be a threat, which is to say, if there were cracks in the futures market, you could expect some really interesting fireworks in silver. I happen to believe you're going to see interesting fireworks in silver anyway. I don't think you need a really dramatic narrative to cause you as a speculator to buy silver. But I like to deal with that dramatic narrative because the facts suggest a different outcome. Highly unlikely. I remember that as pernicious as government is, they tend to do the easy things. If they lower the interest rate, which increases inflation, inflation is a tax, and it's popular. If they increase taxes on the rich, the people who aren't rich think this is a very good thing. The government doesn't need particularly to do politically unpopular things to steal from you. The government can do popular things to steal from you. The idea that the government is going to steal your IRA is an example. I think is highly, highly, highly unlikely. The idea that in an economy that they describe as the best economy in humankind requires an interest rate decrease is a different way of stealing. Of course, their most effective way to steal, Dunnigan, is to index benefits to the CPI, which understates inflation, while allowing the continued deterioration of the U.S. dollar, while simultaneously not indexing income taxes and capital gains taxes to inflation. This taxation benefit relative to benefits that has to do with the discrepancy between the CPI and the real rate of inflation is one of the most effective and pernicious forms of theft. Well, it's the most effective and pernicious form of theft, save an armed invasion of an adjoining country, that I've ever seen. Yeah, absolutely. I remember well the bull market of the 1970s. Those were my formative years as an investor. In that decade, 1970 to 1980, the purchasing power of the U.S. dollar, according to the then Office of Management and Budget, declined by 75% in 10 years, and the gold price ran 30-fold. A truly memorable bull market. In the middle of that bull market, many people forget that in 1975, there was finally popular outcry against inflation. And Congress and the Fed decided that they were going to break the back of inflation and increase the interest rate. They did that, and the gold price fell from $200 an ounce to $100 an ounce. And the then Philadelphia Gold and Silver Stock Index fell by 65%. And it did it in 10 months. It's important to know, though, at the end of that period in 1975, because it wasn't just the gold market that got impacted. The stock market sold off. The bond market got obliterated. Housing starts basically stopped. Consumer durables that are financeable, like automobiles, fell apart. So Congress lost their nerve in a hell of a hurry. And when they took the interest rate down at the end of 1975, savers and investors in the United States and around the world understood that U.S. society capitulated in terms of keeping the dollar strong. And people who got shaken out by that 50% decline in the gold price missed out on a move from $100 an ounce to $850 an ounce in 5.5 ensuing years. I'm interested in this question because I think the political pressure in the United States right now is around another concerted interest rate drop. And that interest rate drop, given the strength in our economy, particularly relative to other economies, will signal to investors and savers around the world that U.S. society and the U.S. government is uninterested in protecting the integrity of the U.S. dollar. And I think gold's response to a real interest rate decline or a couple of 25 basis point rate cuts could be dramatic, truly dramatic. Maybe not as dramatic as 1975 was, but truly dramatic. It does depend on your individual situation. If most of your portfolio is in long bonds and you're a pensioner, if you're going to get whacked by inflation, you probably need 30 or 35% of your net worth in inflation countermeasures, which is to say gold, silver, platinum, and palladium, that kind of thing. If you're a younger person and you're a skilled person where you have inputs and you can increase your wages at the same time as the dollar deteriorates, and you have time to come back from mistakes, you can own much less. This is what I will say, Dunnigan. This doesn't need any couching. The market share of precious metals and precious metals-related securities in the United States is 0.5%, which is to say 0.5% of total savings and investment assets in the United States are comprised of physical precious metals and securities surrogates. The 4-decade mean is 2%. And I would suspect in this market we're going to overshoot that mean substantially. I have a very difficult time for most people. Well, first of all, I have a difficult time for anybody that doesn't save 10% of their income pre-tax. There's a bunch of people who want to live rich, but they don't want to get rich. And there's a contradiction there. And you need to be a capitalist to get rich. You need to have some capital to be a capitalist. You need to save to get that capital. So the first thing is save 10% at least pre-tax. No ifs, ands, or buts. And save and invest the rest. And I believe that some portion of everybody's liquidity, but probably 20 to 25%, or depending on who you are, 50% of your liquidity should be in gold. If you save in US dollars now, which you must do, by the way, you must maintain liquidity. If you save in US dollars, you reduce your purchasing power by savings. You do it because the liquidity gives you the ability to survive and thrive in liquidity squeezes. But maintaining your purchasing power takes gold. If someone came to me and said that my portfolio is 20% liquid and half of that is in gold, which is to say 10% of their portfolio is in gold, I would say good work. Nice work. Remember that if you use gold like I do as insurance, a small premium, the premium being the cost of your gold holdings.
Gold and silver have once again captured the spotlight as America teeters on the edge of unprecedented financial and political instability. With Donald Trump's recent surge in polling numbers despite multiple legal challenges and the U.S. economy walking a tightrope of inflation, rate uncertainty, and record-breaking debt levels, it has become abundantly clear that the fiat system, rooted in endless money printing and blind trust, is broken. Gold and silver are not just alternative investments anymore. They are lifeboats in a storm of economic and institutional collapse. Every fiat currency in history has eventually failed. The US dollar, once backed by gold, now floats on the whims of policymakers and central bankers. The Federal Reserve claims to fight inflation, yet it created the very problem with years of near-zero interest rates and trillions in stimulus. And now, with CPI inflation numbers still sticky and consumer sentiment in freefall, they've cornered themselves into a lose-lose situation. Raise rates and tank the economy, or ease and ignite another inflation wave. Either way, fiat suffers, but physical gold and silver, finite, real, and time-tested, thrive. In the last few weeks, silver has quietly outperformed many other assets, pushing past key resistance levels while being largely ignored by the mainstream media. Gold, too, is testing all-time highs amid global central bank accumulation. Why are nations like China, Russia, and even Poland buying tons of gold while telling their citizens to hold cash? Because they know what's coming. They know the dollar is losing its dominance and that the next financial system won't be built on paper IOUs. It will be anchored to something real. Trump's return to the headlines isn't just about politics. It's about economic sentiment. His recent statements slamming the Federal Reserve and calling for a return to sound money are echoing louder than ever. Trump understands that Americans are losing faith in the institutions that manage their money. Confidence in the Fed is near all-time lows. The Treasury is issuing debt at a breakneck pace. Social Security is on track to go bankrupt. Meanwhile, the stock market continues to float on speculation, artificially supported by Fed jawboning and tech hype. But beneath the surface, cracks are forming. Young investors are waking up. They're beginning to see the trap. Save in dollars, and you're guaranteed to lose purchasing power. Trust in stocks and crypto, and you're subject to manipulation and regulatory whims. The only assets with a 5,000-year track record of preserving wealth through every war, recession, and regime change are gold and silver. And right now, silver is arguably the most undervalued strategic asset on Earth. Not only is it a monetary metal, but it's also essential in solar panels, electric vehicles, and industrial applications. The supply is shrinking while demand is surging. This is not a speculative narrative. It's a supply chain reality. Meanwhile, America is sleepwalking into another debt crisis. With over $34 trillion in national debt and interest payments now rivaling military spending, the writing is on the wall. The government has no plan to pay it off. The only tool they have left is inflation, silent theft through currency debasement. If you're holding dollars, you're the victim. Every printed dollar makes your savings weaker. Every stimulus check, every bailout, every new government program funded by the printing press, it's a transfer of your wealth to the state. Look at the banks. Regional banking stress has returned, and big names are warning of a new wave of collapses. If even one major institution falls, a domino effect could ensue. And with FDIC reserves under pressure and trust in banks declining, people are beginning to ask serious questions. What happens to my savings if the system locks up? If you can't hold it, you don't own it, and that's why physical metals are making a comeback. Gold and silver require no counterparty. They cannot be hacked, frozen, or inflated away. They don't rely on government promises or Wall Street gymnastics. In times of war, regime change, or collapse, like the world is inching toward now, they are the final fallback. Just this week, Trump warned that America is closer than ever to losing the dollar as the world reserve currency. That's not alarmism, it's fact. The BRICS nations are actively developing a gold-backed trading currency, and the world is watching. The petrodollar era is ending, and with it, the dollar's dominance. Gold and silver will outlive fiat. They have outlived every empire that thought it could print its way to prosperity, and they will outlive this one too. While Wall Street distracts you with AI stocks and debt-fueled bubbles, the smart money is quietly accumulating hard assets. If the monetary system resets, and history shows it always does, those holding metals will have purchasing power while everyone else scrambles for crumbs.